Well, what do you think, Samantha? Should we, think we're ready to get started? Or think it's
Yeah,
enough time for everyone to join us?
yeah, it should be.
Okay. All right. Well, let's
Hi
get going
everyone.
then.
Oh. Hi everyone. I'm delighted you could join us for the final NED Forum of the year. My name is Samantha Taylor and I am i5 Global's Research Manager. Today we are covering two different topics. We will be presenting what we believe are some of the more interesting findings that came out of this year's Director Survey. We think there are a number of people joining us that completed the survey and would have read the report we published on it in the NED's November issue. If you have any questions on that, please do use the Q&A button at the very bottom of your screen and we will endeavour to answer them. Following our discussion on the Director Survey results, we will be switching gears and discussing risk governance with Dr. Peter Cripwell, who is the CEO of Risk System. We aim to finish at around quarter to the hour and we expect to move on to Peter for the second half of the session. I will now hand you over to Simon.
Thank you very much, Samantha, and welcome to you all. I'm delighted you can join us just a few weeks as it is before Christmas. And I know that we have, I believe that we have people from pretty much all the major fund jurisdictions attending this discussion today, and indeed people in the US and in the UK and in a number of other places too. So welcome to you all. We're delighted you are here. As this month's Fund Forum, NED Fund Forum is an open session to everyone, I should say, for those of you that don't know us, and I believe there are some people joining us that don't, that i5 Global, who are the publishers of the NED, is a research and media house based in the City of London, and that we have 3 publications and 1 weekly. It is a global macro weekly. The NED, incidentally, is, as we go into 2025, going into its 14th year of publication. So we have been doing this now for a reasonably long period of time. We have an awful lot to cover today in a deliberately short period of time. So what we are going to do is really only pick out a few of the most interesting talking points from our very recent director survey. If you would like information on the sample, which was incidentally pretty much all fund directors, or you would like the full results, we will be delighted to send you the November issue of the NED, which has all that information in it. But I think we could save a lot of time if we skipped all that, then you can read about that at your leisure. I believe, as Samantha just said, that we do have at least 1 or 2 people, and hopefully perhaps more, who did respond to us on the research. And as we've said to 1 or 2 of them, you are welcome, if you'd like to do so, to put in questions during the first half of this session today. But as Samantha said, halfway through, we're going to change gears, and for the second half we're going to get into a subject that we really think is hugely important, and we're going to spend a lot more time on next year, which is risk governance, risk oversight, whatever you want to call it. And we wanted to have this session with Peter Cripwell on the eve of our expanded coverage. So Samantha, if you wouldn't mind turning over to the first slide. As I say, we're just picking out a few things at relative random that we thought, or I thought, was particularly interesting. Here's the first one. This, by the way, the research was done in various different segments, and there was, I think it was the first part of the research was on board effectiveness. And so we asked the question, do you think that fund boards could be more effective? And I think this is an extraordinary finding. I perhaps didn't realize back in early November when we were putting the results together, perhaps how extraordinary it was. 92%, so near unanimity, think that fund boards could be more effective. And the thing I reflected upon when I was putting this together now, and rather than last month when we were publishing the results, is that if almost all fund directors think they could be doing a better job, I wonder, is there another professional body that is out there in the world, professional bodies of, I don't know, doctors, lawyers, dentists, you name it, who would say the same, that if the vast majority of them thinks that they could be doing a better job? Or is it really just fund directors amongst the professional classes who are basically saying they're not actually not very good at what they do? And it's quite an interesting finding if you think upon it in those particular terms. And I've tried, and there's many more quotes published in the issue, the November issue of the NED. We picked out a few, what I thought was a wide variety representing some of the other points were made. There's quite a lot of repetitive points when you ask people for quotes, but I picked ones that I think were all in different areas. I'm quickly going to touch upon those. Annual board self-assessment should be mandatory. I have no idea how often boards do self-assessments. I think it probably depends on the jurisdiction. Some will do them in some jurisdictions more than others. Next one, there's usually a lack of investment experience on them. That's always been the case since we started 14 years ago. In the traditional fund governance areas, I wouldn't necessarily, I'd be interested in people's views, think that's necessarily going to change very much. Very much agree with whoever wrote there should be more focus on risk oversight, and that's what the second half of today's forum is all about, which we'll get onto in a few minutes. More subject experts are needed, especially or particularly in specialist funds. Those of you who are our subscribers will know very well that we have been doing a lot in emerging asset areas in the NED recently, and we'll do even more next year. And those two areas, particularly sustainability, the sustainability sectors, which are growing very quickly at the moment, and of course, digital, and there's various different things happening in the digital space. So especially in those areas, there is a need for subject experts, but I think across the board, whoever said that is making a very good point. Ensure that boards have background and experience diversity. Yes, very much, not so much gender diversity or not so much racial diversity, but certainly diversity in terms of their experience and in terms of a background will be something that we think a lot of boards would need. But of course, if you're in a traditional fund jurisdiction, that's probably quite difficult to do when everyone's background is in the law or in fund accounting or whatever it may be. Better identification of what's the fund manager's responsibility versus the board. Yeah, that's an interesting one. We've never had that one before. An interesting one to reflect on. I will leave that one hanging. Can we move on to the next slide, please, Samantha? Director selection. So if 92% think boards could be more effective, we have here 96%, so even closer to unanimity, that think director selection procedures can be improved. This is an area of particular interest of ours because we are occasionally informally involved in director selection matters for some managers through our selection intelligence service and through Atlantic Fund Intelligence, where particularly we help US managers looking for information on coming to Europe. From our experience of doing that, I mean, the big takeaway is that every situation is different, and sometimes surprisingly largely different. It's even difficult to come up with any kind of meaningful generalities at all about what's involved in that. So it should be more professional, and generally we don't think it is, but it's all over the place in many other ways as well. And so that actually sort of reinforces what somebody has put down as we've had here on the third point, that there should be an industry standard. And I will just say quickly in passing, we couldn't do that. We wouldn't want to do that, but we would certainly love to lend pages of the NED, space in the NED, to anybody who wanted to put together an industry standard or give advice on how selection could be improved. Procedures being more transparent, absolutely. I think at minimum, and this has been mentioned in the NED many times over the years as well, at least in the annual reports, how people are selected should be referred to. I don't think that does happen very often, if at all. And certainly there should be more transparency in the selection procedures than there is today, especially in the offshore centers. And finally, as somebody says here, the process is mainly done by the asset manager stroke promoter. Is obviously that's going to be done in their interest if that's the case, and that's probably, you know, inevitable. So on to the next slide, please, Samantha, if you may. Workload. This is, by the way, I've generally picked the areas where there is much more of a majority stroke the unanimity in terms of the overall conclusions of what many people think in terms of the results of this research. So I thought this was interesting. We haven't had some bits of this perhaps in the past, but not so much as we got this year. The nature of the work is changing. And we had a few variations on exactly that point this year that, to repeat, we didn't really have before. And what perhaps is that? Somebody else said more complex fund strategies. There is somebody else, more regulation and compliance. And somebody else said that more managers or some managers need more guidance than perhaps was the case in the past. So the job is, it seems, according to the overwhelming majority of the people who respond to our survey every year, getting continually more challenging. But, and here we move on to the next slide, please, Samantha. Here's the bad news. Whilst it's getting more challenging, fees aren't really going up very much, if at all. They are in one or two jurisdictions, and that's quite an interesting point to make. We'll see what happens next year. But for the first time we've ever said this, and I think we've been in this survey for about 8 years now, there is a divergence going on in terms of fees. One or two jurisdictions, inflation is, inflation is creeping into the remuneration, but not in others. I don't think we've seen, I can't honestly remember, I should have gone back and checked, sorry, when we ever increase, when we when Cayman had a lower amount. I think we've been stuck on 7,500 for a long time. By the way, sorry, I should tell you how we do this. In the survey questionnaire, we ask, what is the generally lowest accepted minimum in your jurisdiction as to be a fund director of a typical fund? Because of course, every remuneration is all over the place, and we came on to every other jurisdiction. There's a wide variety of fees, and we know there are some houses in fund governance businesses in Cayman wouldn't take 7,500 for a directorship, but the generally accepted figure from several many people who will respond to the research will average out at 7,500. Once in a blue moon, we might even get a 5,000. But of course, there may be in Cayman, people tend to have quite often, not always, but sometimes have quite a lot more directorships than they would do in some of the other jurisdictions, which may compensate for that. But we have here, particularly in the two jurisdictions which have an asterisk next to them, in Jersey and in Guernsey, we have had this year an increase in fees. Now, the reason they've got an asterisk next to them is that because we are only counting from those jurisdictions the directors of private funds. Both in Guernsey and Jersey, there's very large listed fund sectors, and the fund directors are earning substantially more, really in many cases, or in some cases, very substantially more, six-figure sterling remunerations as independent directors of listed funds. But they are often, if not always, acting also as directors of private funds, but they clearly wouldn't want to take on a position as a director of a private fund for a fee level that would be ridiculously lower than what they were doing as a listed fund director. So that is the nature of those two Channel Islands. They're very different from the other jurisdictions, but they have been going up in comparison with when we've asked the question in the last couple of years. Luxembourg and Ireland, not really much of a change, because we always convert this into dollars. When there is a change, it's normally because there's been changes in the exchange rate, and that was the rate we did when we put this survey together about a month ago for the pound dollar and the euro dollar. So that's why those figures can change a little bit from there. So that's all I want to say on fees. I think this is we have one more slide before we come and go and get Peter, I think. Yes.
Yeah.
Before I move on to the risk side of this discussion today, I just wanted to tell you all about what's coming up with the NED in 2025. This is much more significant to us than it would be to any of our subscribers, but we're changing the subtitle of the NED for a very good reason next year. It's been fund governance up to now. It's now going to become asset and risk governance. And that for us is a very important change because we really do want to cover governance outside the traditional fund structure. There's a lot going on, particularly in the emerging asset classes, which is outside the traditional fund governance, pool fund structure. And so we will be covering that, and we're going to be tracking that. We're doing a number of things to track that in a number of different ways in the NED and also in our alternative investment publication, which we're expanding for next year too. So there is a lot of activity of investors going in, particularly in the sustainable sectors, going directly. We think there's a lot of governance issues that need to be addressed in those areas, and we intend to address them, hence the reason for the subtitle change. But risk, as I've already referred to, and we're coming on to in a second with Peter, is a hugely important area in this crazy world where we're going to be yet more on risk as well. So that's our new subtitle. As for the focus on emerging asset classes, I've already said quite a lot about that, but we do think that's where some really interesting things are happening and in bad need of more professional, in many cases, governance structures, and we plan to do a lot on that next year, and as well as forums as well, and so which I mentioned at the bottom here. This year, I think we've had 4 quarterly NED forums. Next year, we're going to do them much more often than that. I can't say we go as far as monthly, but maybe about 8 times next year, we hope to do that, because there's so much stuff that we hope to cover, and we do enjoy putting these things out in so we can have these kind of debates. I see, Samantha, before I hand over to Peter, I see that there is a question. Perhaps we have, in the seconds before we go to Peter, just quick, can you just quickly read it out?
Yeah. So if being a director is becoming more like a compliance function, as your survey implies, will it be able to attract the right people to serve on boards, particularly of complex funds?
Very good question. I don't know is the answer to that question. Perhaps not, and that may be part of the problem. If it is, it's not necessarily happening so much in Cayman, or perhaps necessarily other offshore centres like the Channel Islands, but certainly in Ireland and Luxembourg, I hear that it is becoming more like a compliance function. So is that changing the nature of the type of people who are doing the job? I don't know. But interesting question. Sorry, but we can't explore it anymore. I'm glad somebody put that in. Another question has popped up. This should definitely be the final one before we get Peter.
Okay, so the next one is to improve standards and get new blood and fresh thinking onto boards. We need term limits. Why does the fund industry resist them?
Yes, that is, by the way, sorry, as I said at the beginning, we only touched upon a few areas. There is a section in the research on term limits. We do that every year anyway. And it is one of those great subjects for debate. Should the industry have term limits? I don't have a personal view on it, but we're very happy. There's very good points made on both sides of that debate by people, whether there should be term limits. I think I'm right in saying this term limits are used in most other areas of directorships of corporate boards, etc., but they're not hardly ever used, as far as I'm aware. Someone correct me if I'm wrong, in the fund business, and perhaps they should be. But somebody maybe with a particular interest in that, it does get people very animated. So I think we'll probably. Sorry, we didn't have time for more questions, but as I say, we'll be doing a lot more forums next year, and we'll be writing about this as we've done many times in the past as well, and we can get into these subjects again then. So I think we will say goodbye to the many joys of our research, and hopefully we can move on to a subject I personally find absolutely fascinating. I've already said we're going to be doing a lot more on next year, which is the whole area of risk. And I noticed somebody did say in their response to the survey that we should be more on risk oversight by boards. So hopefully we will have Peter coming up onto the screen.
Yeah, should be any second.
Whilst he's coming up, may I? Oh, hello, Peter. Hopefully, I think you're on your way up. I'm delighted you can join us. There you are. Hello. Very warm welcome to the last NED Forum of the year. Delighted you can do this so close to Christmas. Dr. Peter Crick was the CEO of Risk System based in Dublin, one of the few entities that I think I'm right in saying, Peter, standalone specialist risk information providers in the industry. So welcome, delighted you can make it. Perhaps we could start by asking you to outline exactly what Risk System does.
Thank you, Simon. Fascinating review of the surveys. I have to say I was very impressed. What Risk System does is that we are a funds specific, so that means we only deal with funds, provider of risk, regulatory risk, and data management services to the funds industry. So what that means is basically when we engage with the client, we provide them with a comprehensive, starting with we integrate data, they don't have to worry about that. We then normalize it, we enhance it, and then we provide our clients with exactly the risk management services, the regulatory risk services, the compliance services that they require. And then we back that up with providing them with the reporting services and a number of other services that we can utilize their data to provide them with extra information. So effectively what we're trying to do is make certain that when clients have a risk problem or a risk issue, we ensure that that issue is completely covered by what we do.
Right, thank you. So let's get into the some of the areas that we touched upon in our recent prep call. How would you describe risk governance at the oversight function, particularly under AIFMD? And after you've done that, if you could, for any Americans listening to this afternoon, if you could perhaps explain how it's different over here in Europe from what they are used to over there in the US.
Indeed. I think the main point about the AIFMD is that it's trying to put process on the oversight of funds. We're not, and I think as people try and say there's a whole load of bureaucracy and the rest of it, that is not the object of the AIFMD. What it's trying to do is say, if you're going to be selling funds to Europe, which is a huge pool of potential investors, what we're trying to do is make certain that you have an appropriate amount of oversight to ensure that when you are selling, that what you are selling is consistent with what you are telling investors. It's not trying to do anything special. Or what it's trying to say, if you're running risk, do you understand the risk? It's not magic. It's just saying, how do you do it? We're not saying you have to do VAR or anything stupid like that. Saying, look, we need to know what your leverage is. Pretty easy. Funds should know that they should monitor this stuff. That's what it says. If you actually are running risk, irrespective of what it is, you should be able to stress test it. And I'm not talking about the market goes down, you lose money. I mean, that's pretty obvious to all and sundry. What we're trying to do is say, okay, what are the risks that you're taking? And yes, they're difficult. Private equity, God, it's difficult to model. Property. But there are risks that you can stress the assumptions under which these are being valued. How does that impact you? Do you have constraints in your prospectus? Stress test them. Stuff you really should be doing, but it's just saying do it. And lastly, and very importantly from the European perspective, liquidity. You are telling investors you're giving them a liquidity. Maybe it's quarterly, maybe it's not, maybe it's yearly. Make certain that the investments you are making are consistent and demonstrate it. None of this is really rocket science. It's just sort of saying, if you want to access the huge pool of investors that is in Europe, do stuff that's rational. You should be doing it anyway, so it's not like we're overlaying a huge burden on you. You're probably doing it internally. We just want you to evidence the fact and show that, yeah, that's how we do it. Nothing too complicated.
When we talk, as we do from time to time, to US managers that aren't familiar with Europe or the AIFMD, this comes across as quite foreign to them. And how do you get involved in those type of discussions with people that don't know what's going on over here from the US from time to time or not?
I do get involved in them, and in reality, it's more a matter of saying, you're doing this, aren't you? And in their the managers do have an understanding of the risk they're taking. It's more of a matter of just saying, what exactly are you doing? Put it down on paper. Maybe it's in somebody's head. Most Most of the large funds have risk management departments, and they're completely covered. It's just that the people that they're at the front of the desk aren't actually communicating with them. All that is happening is that, where is this information? Put it up front. We know where we are. Give it to the board, and that's the main thing. The whole point about the AFMD is that it's the board that reviews this stuff, so that we're not trying to constrain the managers. We're merely trying to ensure that the board, who are responsible to investors at the end of the day, have sufficient information to ensure that they are doing a proper job of oversight.
Okay. So let's move on to the subject of breaches. And we touched upon that again in our prep call the other day. There's obviously two different types of breaches. There's the deliberate type, and then there's the inadvertent type. Without wishing, obviously, Peter, to get you to name names, how often do you come across, I don't know, in an annual period, whatever, define whatever time period you want to define, both the deliberate and the inadvertent? Obviously, the inadvertent, I'm guessing, happens obviously a lot more often. But how often are you?
Depends on the strategy, in truth, and actually the managers sometimes. Um, in reality, I mean, just to clear up for people, inadvertent is where things happen because the markets move. So, for example, in UCITS, you're not allowed to hold more than 10% of a given issuer. So you're 9.9% of a particular bond, of a particular issuer, Citigroup, for example, and the market moves and you get over 10%. That is an inadvertent breach. In that situation, you have to get it below 10%, but you're given time. Helpfully, the regulators have not told us that amount of time, but it's probably about 4 weeks, most people agree. And you can get out of it, but you're meant to always operate in the best interest of your investors. So they're not saying cut now, it was inadvertent, didn't mean it to happen, it's happened, work your way out of it. Advertent, which are normally quite rare, is if I'm at 9% in Citigroup and I buy another 2%. That is a serious problem. They're a serious problem for a number of reasons. Firstly, you've got to alert the central bank that you had an advertent breach, which is not fun. Secondly, and possibly more painful, is that you have to, if you've made money, the fund keeps it. If, however, as a result of an advertent breach, you lose money, the fund manager has to recompense the fund for any losses. So there is a real and serious effort has to be put in to ensure that you're calculating this properly. So there is a cost of actually working out what you owe, and then you got to pay it back anyway. As to the frequency, actually, inadvertent breaches happen. I mean, irregularly but consistently. So there is, these things happen. It's not something that people want, but they happen. Um, Advertent breaches are more unusual, but one thing I should say is that the regulators consider all cash breaches to be advertent, irrespective of whether they're inadvertent or not. So you got to be they are very, very keen on making certain that you can manage cash properly, which is probably sensible. If you can't manage your cash properly, why are you being allowed to play around with transferable securities and derivatives? But that is a serious, if you mess around on the cash, you've got to make certain that you hold only a certain amount with counterparties. So you've got to be careful about that. And when you're sort of, if you're invested in T-bills, make certain that when your T-bills mature, you're buying on the same day. Cash comes into your account and you haven't cleared it, you are now in breach. Central bank gets informed. Bad things could potentially happen.
Well, apart from the penalty that you have to pay back if you lose money, what are the other bad things that could happen? And how much is the board involved in this process at this stage?
Well, the board gets involved when the central bank decides that you're doing bad things, that the funds which are under your control, and the board is responsible for the conduct of the fund. The board is responsible to the central bank. I can't speak for the central bank, but clearly if there are issues, and continual issues, that is a problem. And at which point the central bank can get involved, or the regulator can get involved. So that is a serious problem, because if if you have a situation where funds within a manco AFM are continually advertently breaching, yeah, not a happy scenario.
Yeah. Interesting one. I think that's a subject I'm definitely going to try and come. We'll talk again sometime next year about that, because I'd love to explore that in more detail. I want to move on in the short amount of time we have to the subject, a subject you and I have discussed on several occasions over the last few years: fund board liquidity and liquidity stress tests of funds. Particularly if you're as bearish as I am at the moment, and you think to yourself, well, we could be, and thanks to our good friend Mr. Trump, with all his tariffs and God knows what other crazy activities are going to descend upon the world next year, and the retaliation of the Chinese, or whatever it is, something that no one's ever thought of, that we do have a scary world going on and crazy stuff going on in markets. So liquidity of funds, as you've said in the past on the many occasions when we've had the discussions, of course, that's what the directors are responsible for. And I hopefully not putting words into your mouth, Peter, but you say that, that the fund boards aren't always fully on top of their liquidity responsibilities. Would that be a fair comment that you would have made in the past?
I would always hesitate to say a fund board is not on top of its responsibilities. That seems like
You
dynamite.
may not have
What
said that, but that's a cheeky bit of journalistic exaggeration.
What I do think, and I think it was interesting that from your survey, was you saying that fund boards think they need more investment experience. That's a double-edged sword. I am personally against fund boards double guessing their managers in terms of investment. Against that, however, liquidity is a primary responsibility for boards. And I really think it's sort of, allowing investors to get their money when they want their money has got to be the highest obligation of a fund board. The fact that funds lose money goes up, goes, mom and pop want their money back, they have to get their money back. And this, I think, is one way. Now, how do you get the liquidity experience without getting the market experience? Not sure about that one. But the point is that liquidity is complicated on a general basis. If you're invested in nice, happy-go-lucky equities, regulated markets, yeah, easy peasy. When I do, and we do our stress tests, our reverse stress tests, you name it, we've got liquidity all over the place. When you're talking about liquidity going down, you can say, well, the volume's gone down 15%. How does that hit you? Yeah, fine. The real problem, however, is when you're in markets that aren't that nice, linear or whatever.
Like the beginning of COVID, when there was a lot of panic.
COVID was well, actually, weirdly, liquidity volumes doubled in COVID as everyone was running for the exit. But that's a different. What I'm really thinking of is situations in COVID, for example, asset-backed securities. It didn't go from X to X divided by 2. It went from X to 0.
Right.
OTC derivatives. It didn't go from X, it went to 0 because no investment bank wanted to have anything to do with it. I think that's the issue which boards need to consider. When you're in markets and OTC derivatives, asset backs, or the wilder end of the fixed income market, emerging markets, they don't slide, they don't go down, they just go, no, we're not trading today. And in that situation, how do you respect the liquidity and the liquidity that we are claiming to give investors? And I think this is where boards need to get more involved, because it's not that the numbers they're getting are wrong. I'm absolutely convinced the numbers are absolutely consistent with the assumptions behind their derivation. The board needs to challenge the assumptions. They need to consider.
Do they have the capability in terms of the personnel on the board to do that?
Getting back to my previous point, it's difficult to get people who understand, who can challenge liquidity estimates. Some boards will, some boards won't. That's not, I'm not going to sit here and say people don't board members who are, in my experience, very diligent in their operation. But it's that understanding of you have 30 funds in a manco. Which ones are the ones you need to care about from a liquidity perspective? Which ones are not the ones you need to care about from a liquidity perspective? I think that's something which, when you're sort of, when as a board director you're looking at this, you'll get large amounts of paper or whatever, and you'll see liquidation figures. It's the ability to challenge those. That I think is a key skill.
Yeah.
Whether or not these numbers, yeah, my company can provide you with large numbers of, pretty pictures and liquidation times, etc. It's which ones actually are consistent with assumptions and which ones sort of go, are you sure about this? Does this make sense? I think that's a key responsibility of boards because, as I said earlier, giving your investors the ability to take their money out when they want it is fundamental.
Yeah. And you didn't quite say this today, but you have said this in the past, and you half implied it just now in what you've been saying, is that the portfolio managers tend to be a little bit more optimistic about their own liquidity situation.
Sorry. I mean, one would hesitate to say lying, cheating scumbags, but the reality is,
This is why we have you, Peter. This is why we have lying. This is the headline for this. Lying, cheating scumbags will be in the banner headline of this, the article on this discussion today.
which
Thank you very much.
which I hesitated to say, but the reality is,
forget that comment.
it's not in. Why do you have independent auditors? Why do you have independent anybody? Because the people whose job it is, you're employing the fund manager to do the best thing they can. And that's important. Trying to believe, their liquidity estimates will be optimistic on a good day and fanciful on a bad one. And that's not what you're employing them to make money. We'd like them to manage liquidity. That would be a great thing. But that's why you have the manco. That's why you have the DPs for risk, the conducting officers, to make certain that what they're doing is consistent. And this is what the board is there to do.
Right.
It'd be nice if fund managers worried about that, but when they give you a liquidity estimate, yeah, enjoy.
Pinch of salt. Yeah. Okay. Two areas quickly. We are sadly running out of time. One very practical question, then a bigger question. So the practical question is something again you and I have discussed from time to time in the past, which is the valuing of illiquid alternative assets and the difficulty involved in doing that. What are the difficulties as opposed to a liquid market-based thing? In summary, how would you describe that, and what can be done about the problems that arise here?
Sorry, everyone, when you're trying to value illiquid assets, you're going to make assumptions. And this is the key thing, key role I think a board can do is that, finance, and certainly in this particular case, there's an obsession with precision. Valuing illiquid assets, you're going to get a number, but is it the right number? Who knows? You'll only know what the right number is when you sell it. In between buying it and selling it, it's a makey-uppy sort of thing. That's reality. We have to live with that fact. What you care about is what are the error bars around it? And this is where the board has value, because the board challenges the assumptions under which it is valued. The board looks at it and goes, okay, so you assume this, 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 and this. And, private equity, you've got EBIT growths, WACC, whatever. What is the impact of making these assumptions on the valuation? Is that valuation actually reasonable? This is where, so there are many assumptions going into it, and all illiquid assets, you don't know what the right number is. What you're trying to make certain is that the assumptions that have been going in and the data that's going in behind it is reasonable. And this is why, getting back to the original point about AFMD, stress it. Work out whether or not this is crazy stuff or not. And then you actually have something. But in reality, it's a whole load of assumptions. And, the analysts try to pretend it's a lot more complicated than it is. It ain't. But there's always a couple of key assumptions that gone into a valuation. That's what you need to worry about, and that's what you need to stress.
Thank you. Last question, which is the big one, and be as bold as you can be in your response, please. What more, if anything, should boards be doing on risk oversight? And by and large, do they take their responsibilities seriously enough?
Having heard your survey, one has to be nuanced. The reality is, with the boards have got more responsibilities, and the increasing size of board packs indicates they have much more to do. How much of that board pack relates to the risk that their funds have taken? I don't think that's increased. I think all of the other stuff has increased dramatically. But at the end of the day, the boards are responsible to make certain their investors get what they paid for on the tin. And I think what that requires is not sort of a step change. It requires that the board takes steps not to sort of give them sort of, they don't need to know about VAR. They don't need to know about, credit models. What they need to know about is, where are the problems in these funds? Every fund has 2 or 3 things you need to care about. The board needs to understand what are those things for the funds under their control and ask intelligent questions. They are intelligent people. They can ask intelligent questions, but if they don't know what the questions are, or if they don't know the areas they're in, they can't do it. But it's understanding from a risk perspective what's underlying, where are the key points underlying their the assets into which their investors have put their money. And I think that's, again, I'm not 100% convinced you need to have, the last trader out of Goldman Sachs to come onto your board. But what you do need to have is people who are obviously invested in the overall health of the operation, having the information to allow them to ask the intelligent questions. That's, I think, the key point.
Last question then, do you think they are, generally speaking, asking the intelligent questions from your experience?
Some do, some don't.
I think
I'm hedging on that one, but then I'm from a risk perspective. What do you expect?
Well, thank you very, very, very much indeed, Peter. Very kind of you to do this before you go out and do your Christmas shopping. We'll go and watch some Irish rugby or whatever, and this particular weekend.
Leinster. Go Leinster versus Claremont.
I had to even upgrade my outrageously expensive subscriptions to a thing called Premier Sports to get these wretched games. They're not even on BT or Sky anymore. It's really annoying.
I had to do that last weekend as well. Devastating.
Well, we got something in common then. Yeah, it was devastating. Peter, thank you very much indeed. Have a great Christmas and hopefully see you sometime early in the new year. Bye-bye.
Thank you. Thank you, Samantha. Have a good day.
Bye.
Right, whilst Peter's going, I'm just going to say to everyone that to repeat to a certain extent what's already coming up. We've got a lot, as I've already mentioned, on emerging assets next year, including not semi-formal education, but much more education type stuff in these forum type situations than in articles in the publication. That is happening. Risk, as we've just been talking about, is going to be a big area. We believe very strongly we're in an increasingly dangerous geopolitical world, and that will, we fear, may well feed into markets, and how that affects funds and other investment vehicles is an area we'll be covering very, very, very frequently indeed. So hopefully have you back with us next year. Have a great end of the year. Enjoy the last few weeks before Donald Trump becomes president again, and see you shortly after that if we're still all alive at that particular point in time. Goodbye. Have a great Christmas. See you again soon. Bye-bye.